Kind of come up with this term, the everything, everywhere, all at once rally, which is basically bullish stocks, bonds, gold, Bitcoin. And I would say I'm bullish on all of those heading into the end of the year. Of course, there's going to be short-term fluctuations and bumps along the road as there have been, all year. But I think that we're kind of setting up for almost like a perfect storm of bullishness for as far as the eye can see. So you've got 3.5% GDP, 4.3% relatively low unemployment, central banks cutting, um, AI capex out the wazoo, fiscal spending still not letting up, probably going to expand. And you put all of that together, and I just find it hard to make a bear case. And shockingly, there are still a good number of bears out there, which makes it, ironically, even more bullish.
Hey everyone, and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back Mel Mattison. So Mel is a writer and financial services veteran with 20 years of experience in the realm of high finance. So Mel, thanks so much for coming back on the podcast.
Well, thanks for having me, Anthony. I really appreciate it, and looking forward to our conversation.
Yeah, really looking forward to it. So yeah, I'd like to start very broad. What are you currently seeing in the markets? Because I think we were talking before, and you've been quite outspoken in terms of you're basically bullish everything. So I'd be really interested in hearing what you're seeing and why you have this perspective.
Yeah, exactly. I mean, I'm kind of come up with this term, the everything, everywhere, all at once rally, which is basically bullish stocks, bonds, gold, Bitcoin. And I would say I'm bullish on all of those heading into the end of the year. Of course, there's going to be short-term fluctuations and bumps along the road as there have been, all year. But I think that we're kind of setting up for almost like a perfect storm of bullishness for as far as the eye can see. What's going to happen in 2027, 2028, I don't know. I'm normally looking at what I would call 6-12 month time frame going forward. And like I said, while there are going to be some bumps on the road, I think that ultimately you have not just the Trump administration in the United States, but you have a situation with large developed economies around the world, as well as with some of the emerging economies. That's just basically putting in this industrial production, build out of the grid for AI, fiscal spending staying at high levels, if not increasing, especially in Europe, looking for increased fiscal spending. And then you marry that with essentially a global central bank easing cycle, lowering rates, which I believe is fundamentally necessitated by the extreme levels of sovereign debt around the world. I just don't think that France and Spain and the United States and Japan and so on can handle 5%, 6%, 30-year bond yields, and so there's going to be a concerted effort to keep rates lower for longer, even if inflation runs in the 3 to 5% range on CPI reports. And that when you put all of this together with a whole bunch of other, bullish factors, I think there's a very bullish labor market dynamic in the United States. You look at the GDP now from Atlanta as we record this on Wednesday, September 16th, forecasting 3.5% GDP. So you've got 3.5% GDP, 4.3% relatively low unemployment, central banks cutting, um, AI capex out the wazoo, fiscal spending still not letting up, probably going to expand. And you put all of that together, and I just find it hard to make a bear case. And shockingly, there are still a good number of bears out there, which makes it ironically even more bullish. So that's how we kind of get there on the broad strokes, but we can get into any details and how that all flushes out, or however you want to take it.
Yeah, it's really interesting to hear your perspective on that, because I guess a lot of people would see these deficits as an issue for markets and the economy, but you're seeing this as positive because basically they're not going to stop. They're going to keep pumping money into it, and what's going to benefit is going to be the assets they're going to benefit. Except people would say bonds, but then you also have an opinion that bonds are still going to go up. So what's the thinking there?
Yeah, I mean, we've had such a rally in bonds. I first was on X saying I saw bonds getting ready to rally about 3 weeks ago. So it was a great call, especially that one day a few weeks ago when like French 30 years or US 30 and US, like 30 years were getting around 5% around the globe, and people were flipping out. And I think that, they've definitely rallied a lot. So I'm not looking for a big rally from here for the next month or two. But as I said, looking out over a 6 to 12-month time frame, I do expect 10-year yields to be in the threes next year for a lot of the year in the U.S. And I am not talking about a huge bond rally, but I am talking about a bond rally that's just going to be kind of a soft undergird to the rally and risk assets, which I think is going to be much larger, which is across that spectrum as well: crypto, Bitcoin, gold, stocks. So with the bond market, I mentioned, I think that, and this was partly a shift and a pivot in the way I was thinking about things earlier in the year, which is originally I had thought that even if, say, bond yields go up, there's just going to be such a shift to short-term issuance. They're going to essentially almost stop, issuing net new issuance of coupon of 10 years, 30 years. But I think that the administration really has their heart set on a lower rates on the longer end, and basically kind of a flatter curve, a lower curve. And the way that I think happens is that you start to convince market participants that central banks around the world are going to keep the short end lower for longer, that they're going to be willing to look through 3.3, 3.4% inflation prints and say, we're still not going to raise rates. We're not even going to talk about raise rates. In fact, we might be lowering rates. And what that's going to do is ultimately, the pricing of the longer end is a string of shorter end yields. And so once participants begin to believe this, and then I think there is going to be this continued, dearth of issuance on the long end, where there's going to be some 10s and 30s and 20s getting issued, but it's not going to be, what it was pre-pandemic, and it's going to be a lot of bill issuance, and it's going to be a lot of treasury buybacks getting more involved. And I think when you put that whole mix together, what's going to contain that long end is that there's just a large amount of people who have to buy it, like very large insurance firms, pension plans that want to match up liabilities. And so you have almost like a built-in demand for a certain amount. And if you keep that amount relatively, low, and then you convince market participants that on the short end, you're not going to get a better yield because we're not going to be raising rates, then people will say, well, I have these liabilities. I need to get, a 4% on a fixed income. I'll buy the 30-year at 4%, or I'll buy the 10-year at 3.7%, or whatever it might get to next year. And so I think there's going to be that demand. There's going to be low supply, and there's going to be forward guidance from central banks that rates are going to be lower for longer. And that's essentially going to keep a lid on those things. And there's also, I think, some underlying structural reasons when you start looking out over longer term time horizons, which obviously long-term bonds do, that are essentially deflationary in nature. And those are primarily twofold. One, of course, AI, which, while in the short run has certain inflationary aspects, longer run, say 5, 10, 15 years out, I think has significant deflationary aspects. And then the other deflationary aspect is really the decline in the size of the labor force across the developed world, where, in the 1970s, which a lot of people talk about the 70s or stagflation, we had an oil shock, and we certainly don't have that with crude in the low 60s. But we also had a very rapidly expanding labor market because we had all of these baby boomers, people born in 1945. What were they doing in 1975, right? They were 30 years old, starting families in the workforce. Women were coming into the workforce. So we had this massively expanding workforce, which we don't have. And so that is going to, again, be a little bit of a temper on per capita growth, or not per capita growth, but on overall aggregate growth, because the labor force just isn't expanding the way it did in previous decades. So I think bond investors are going to start to wrap their heads around all this. I think a lot of them have in the last few weeks, and saying, hey, if we can get the 30-year at 4.8, we better eat that up, because who knows if we'll see that again in the next 10 years.
Yeah, but I guess it's still the risk of unless they're bringing yield curve control. There's just going to be. I know you say they're moving on the forward in the curve, but if there's going to be such a so much more debt being printed globally around the world, and then if you look at how it's being the dollar's being depreciated, not just versus other currencies, but also versus real assets. I think that's the risk that it could also, we see a continuation of, as you mentioned, all these other risk on assets, all these other sometimes risk off assets like gold and the Bitcoins and these other sort of assets that are going to just benefit so much that you'd be stupid to own bonds, basically.
Yeah, like I said, I think that there'd be a rally in bonds, not a huge one, but that's going to underpin the greater rally to occur in the risk assets. And I think what some people have worried about is some sort of a bond vigilante attack. Like these gunslingers are going to come out of the desert, shooting up yields. But basically, I just don't see that happening. And I think fundamentally, I believe that governments will do what they need to do to avoid a collapse, to avoid a depression type scenario. And I think when you look at the, let's say, interest expense as a percent of GDP for the United States, that was around 1.5% of GDP, during the pandemic and before. And it spiked up to where it is now, 3%. So we essentially doubled our interest expense as a percent of GDP in the last few years. And as we're now going to be, over $1 trillion in interest expense a year, I just think that governments can't afford to keep paying all of this interest. And what people will say is, well, the bond market's going to decide that. Nobody can boss around the bond market. And I just don't believe that's true. I think when push comes to shove, governments can boss around the bond market. It's got to be a situation where governments have their backs truly against the wall. And I think, ironically, where people say, well, there's all this debt, that's what's going to cause the bond market to explode. I think there's all this debt, that's what's going to cause governments to step in and take a greater kind of control over monetary policy, whether that's closer connections between the Federal Reserve and Treasury in the United States, whether that's going to be, different changes in the way the Euro system works, because I think there's some big kind of fundamental problems with that system, and the deficit to GDP caps that are there, and the fact that individual countries can't, print money based on their own needs. So I think there's going to be some turmoil, in Europe around how do we handle this situation. But ultimately, I think if the choice is, do we kind of, fixate on 2% inflation target, and do we essentially tighten, monetary conditions to a point where interest expense around the developed world just starts eating up a larger and larger portion of GDP, which I would add is actually kind of a regressive policy where the wealthy are the ones that own fixed income instruments. They're the ones that get the interest payments. So you have about $1 trillion stimulus package every year in interest payments from the US government. 75% of that goes to the United States, 25% of it goes to our allies and adversaries that hold treasury bonds. And the 75% in the United States that get it, it's mostly the wealthy. It's people that have large mutual fund, bond fund positions. So people that have hundreds or thousands or millions of dollars in money market accounts getting 4%. So you're getting essentially a taking of tax money from the population and redistributing it to the wealthy and to our adversaries overseas like China, which it's just not the way that people want the system to work, especially I think the way the Trump administration wants the system to work. And I think that's why they're kind of dead set on chipping away at Federal Reserve independence, because they recognize that they've got this whole policy, this whole grand plan that they want to put into place. And it's like you've got 4 players on the basketball team running around doing all the plays the way they're supposed to. And you've got this 5th guy who says, no, I'm independent. I'm the Federal Reserve. I don't have to follow the plays or listen to the coach. And, I think that a lot of people think, oh, well, that's a big threat to markets. And, a great danger is Fed independence. And again, I just have to look at history. That just has not been proven out to be the case. There have been times when the Treasury has dominated the Federal Reserve. There have been times when in this country we've had a central bank when we haven't. This idea that we need to have an independent central bank, especially in the post-gold standard era, I just don't buy it. I think Federal Reserve needs to be folded in more into the get more with the team, basically.
Yeah, it's really only the last 40 years that it's been a phenomenon of central bank independence. Before, and you said it could be linked to this baby boom, massive baby boom, inflation crisis that then meant that Volcker had to come in and sort of take control of it. But a lot of the times, it's driven by these external factors that the Fed really doesn't have much control over.
Exactly. I mean, how is any change in the interest rate going to affect Meta's CapEx spend on AI? How is it's just the transfer mechanism, and even central bankers will admit this. They'll be like, interest rates are a very blunt instrument. Like if you want to slow down like demand and economic activity, and you're trying to do it by raising rates on the short end, and that's basically crimping so many things for, let's say, a middle class consumer that wants a car loan or a home loan. And then you've got, at the same time, when you do that, you essentially create, as I call it, interest expense stimulus to the wealthy. It just doesn't fit in with where society is right now. And a lot of people talk about a 4th turning. They talk about a great reset. And I think they're right. And I think if we're in the middle of a 4th turning, I think it's helpful to look back and say, well, what type of monetary policies happened during 4th turnings? And if you go back to, say, the Civil War, which was considered to be a 4th turning period in the United States in the 1860s, or you go back to the Revolutionary period, you actually had the United States issuing pure fiat, not even backed by debt. So Abraham Lincoln did greenbacks. They were actually called legal tender notes. It was a legal tender act. The whole Revolutionary War was pretty much financed by a currency called the Continental. And I think that ultimately we could start having a discussion about Congress issuing US dollars that are no longer backed by debt, and basically taking the Federal Reserve out of the loop. And so, because right now, when Congress wants money, they go to the Federal Reserve basically, and the Federal Reserve prints Federal Reserve notes. That's what's on our currency. And basically the way they get it is they issue bonds. So they issue bonds. They go to the primary dealers and they place all this issuance. And at a point in time, especially during a gold standard time, a lot of this kind of mechanistic funding made a lot of sense. But as we've moved into a more pure fiat world, there's not a lot of great reasons why the U.S. should be paying interest on something that it can create by constitutional authority, which is Congress has the authority to coin money, which during a number of Supreme Court rulings, actually during the 1860s, known as the legal tender cases, the Supreme Court asserted that Congress has the ability to essentially create US dollars. So if Congress can create dollars and they don't need to pay interest, all of a sudden that solves a lot of problems. All of a sudden it solves the deficit because we're not having to pay as much interest expense. And what people are going to be worried about is what happened during those other fourth turnings with the greenback and the continental, which was eventually those currencies became worthless. They spun out of control. But and that's probably a likely outcome. But I don't know if the policymakers won't try it. I don't know if they won't say, let's give it a try. Let's put in certain restrictions so that we try to talk to the market and convince them that even if we issue non-debt backed dollars, we're going to essentially not run into this massive inflationary spiral. And it could get to a point where it's just so tempting that they do it. And I think the step along the way before they get there is where we're heading in the next year or two, which is, lower for longer on interest rates, not a massive upheaval of what I just described. But I do think at a certain point down the road, it's very conceivable, maybe at the end of this decade, that there starts to be discussion about issuing non-debt backed US dollars. The last time we did that was in the 1860s.
Yeah, it just sounds like a more efficient way of doing QE, basically. If you think about it.
Yeah, exactly. That's exactly what it is. There's this whole farce with the Federal Reserve, right? I mean, it's like, okay, what do? We're going to issue these bonds. Then the Federal Reserve is going to buy it. And then a lot of banks buy these bonds too. And what do the banks do? They deposit it at the Fed. And then what does the Fed do? The Fed pays interest on reserves. And it's like once the American people really started to understand how the system works and say, okay, Congress could print money and we don't pay interest, or we print bonds that get bought by banks like JP Morgan and Citigroup, and then they go and deposit it at the Federal Reserve, and then they get interest expense on it. And people say, well, why are we doing this? Well, the reason you used to do that is because you needed gold, because there was something that banks had that governments needed. This was why William III set up the Bank of England in 1694. He needed gold, and he gave the Bank of England a charter to issue paper money, the only legal tender in the realm. And basically, he said this can be used to pay for taxes and everything else. And people would go to the Bank of England and they would deposit gold and silver, and they would get these paper notes and they would circulate. And the king could then borrow from the central bank the gold and silver, and then he could pay his troops to go fight France. So there was a need for the sovereign to get his hands on the physical metal that initially set up the need for a central bank. In 1971, that need evaporated, and we've continued to keep the central bank around as a governing mechanism on profligate spending. But it's really not necessary from a mechanical standpoint the way it was during the gold standard times. And so once people kind of understand that basically the Federal Reserve is there to be an unelected, quasi-independent kind of regulator on government spending, and that's really the function. It's not really to fund the government. It's to act as this regulator. I think that there could start to be kind of a discussion about how can we set up an independent kind of regulation on government spending that doesn't need to go through these old mechanisms that essentially enrich the banks. And I don't know, constitutional amendment limiting the amount of dollars that can be created, or some sort of an independent function that the Federal Reserve fulfills that is not necessarily the way that it has, where it basically is like, okay, we're gonna keep the zero rate for U.S. bill issuance, but we're gonna go into the open market to derive some sort of a different kind of overnight rate for banks that's slightly different in the private sector. I mean, it could take any number of forms. It just could be something that I think a lot of people who say there's just no way out of this. Elon Musk did an All In podcast last week where he said, look, the government's going to be toast because of the debt, unless like AI and robots save us. And I think that for a guy who has an amazing imagination, he doesn't have a very good imagination when it comes to monetary policy, because once you start imagining that these things are possible, that a non-debt backed dollar is possible, all of a sudden these problems that people think are insurmountable can be overcome. And so is it going to work? I don't know. But are we necessarily heading for doom? I don't think so.
It does sound like peak Ponzi though. But then I guess also maybe this is what stable coins will be like, and it seems to be the way that things are going.
Yeah, it's extreme, and I'm certainly not saying that it's going to happen anytime soon. And I do think there'd probably be it could possibly done via some sort of obfuscation, and I think in a sense that would be the Federal Reserve keeping the Fed funds rate lower for longer. I mean, I think that you kind of get there if you get the Fed funds rate down to say 2%, which I think is possible in the next 12 to 18 months. It's not free debt, but it's 2%, and maybe markets can live with that and not. It kind of keeps the old mechanisms in place, kind of like a safety blanket. But at the end of the day, I think it's just necessitated. It's necessitated because if the government is going to continue to pay out these massive deficits, they're not going to tell Social Security people your checks are going to get cut in half. They're not going to say to 70-year-olds, you no longer have health care. And those are the drivers. And then the other driver is national defense. They're not going to say, oh, we need to cut defense in half because of the debt. They're just not going to do it. They didn't do it in World War II. They didn't do it during the Civil War. They didn't do it during the Revolutionary War. And they're not going to do it in this century. And they're going to do what they need to do. And if that means monkeying around with the monetary system and changing the way things have worked for the last 45 years, then they're going to change the way things have worked for the last. And this is going to be the Great Reset. And I think one thing that's important to talk about is a lot of people, when they talk about a collapse, they'll talk about all the things I'm talking about, but they think, one, it has to end in complete disaster. And two, they talk about all the things that we did during the GFC or during the pandemic and the money printing. And they say there's no such thing as a free lunch. Eventually, the price has to be paid. And what I would say is that the price has and is being paid. If you're somebody that had $100,000 in savings 5 years ago, and that 100,000 now goes out and buys what $65,000 used to buy you 5 years ago, you've paid a damn big price. And so to say that there's been no price paid, there's been a huge price paid. 20% of the value of the dollar has been wiped out. That's like a 20% one-time wealth tax on every single dollar in existence. So there have been huge prices paid. We've had 50% collapses in the stock market post GFC. I think we got down around 50 COVID. We had a 20% pullback this year. We have these massive drawdowns in equities. We've had basically a massive wealth confiscation via the inflation tax. So to say that there's no free lunch, I agree. but to say that we've paid for the lunch, so let's enjoy it. Let's not quibble about the bill here, because basically it's being paid in real time um, with inflation, and I think that the inflation is going to continue. And so that's what's going to drive even more and more people into these risk assets as hedges against dollar and fiat debasement, which is obviously coming down the line.
Yeah, it's really fascinating. So you said you sort of will look at 27, 2028. Those are sort of the where you see at least things being bullish until. So what are you seeing? I guess, is it true that you're saying sort of 15,000 potentially for S&P, and I'm guessing quite high for Bitcoin as well? Is that sort of where you see this going?
Yeah, I think we could hit 15,000 on the S&P by the end of Trump's term. It's a little ways out. I think when I've been looking at it and looking at my charts, I'm normally in some sort of a wide range at this point, given that Trump's term's not over until January 2029. So this is quite a few years away, but something in that 13 to 15,000 range on S&P, I think is where we're heading if we don't have a massive drawdown before then. And the way that I think that could happen is that it would be a little bit analogous to the 1990s, where and I think we could be heading into this sort of a bubble situation. So again, I've said, look, we survived through this, but we've had these massive drawdowns. So do I think there could be a 50% drawdown in equities before the end of Trump's term? Yes, I do, especially if we have, just like, let's say we hit 12,000 S&P within the next 18 to 24 months, and things just get way overheated, and then everybody goes to the door. And that's a lot of psychological factors, and just overheating, and kind of the nature of crowds, and things that will drive it. And there would be this massive decline, and then there'd be some sort of a response, because that would totally decimate tax receipts, and it probably would wind up in even greater dollar debasement, and even greater prices for gold and Bitcoin eventually. But so I do think that these things years out are kind of a little muddled in my mind of exactly how everything plays out. Obviously, I don't have a crystal ball, but when I look, like I said, my 6 to 12 month time frame, and then always constantly be reassessing, from what I can see on that kind of, I guess you'd call that kind of a short to medium term horizon, is a bullishness for most asset classes, and with the exception probably of the dollar, especially in gold or Bitcoin terms. Against other currencies, who knows? Because like I said, like Eurozone has its own problems that it's going to have to deal with. Japan has its problems. So what exactly happens on the DXY is one thing, but I think regardless of what happens there, in gold terms, you're going to see the dollar fall dramatically during this time period as well.
Yeah, no, really interesting. And I think one thing that you've talked about a lot is sort of the doomers and the gloomers, and how there's a lot of people who think that the US economy has been in a recession for years, but then obviously we see growth and we see the markets continuing to rise. So what do you think these people have missed? Is it just there's been and I think you sort of touched on it briefly to start with. Has there been this massive shift in economy and how things work, or where have they gone wrong?
Well, I mean, I'm sympathetic to the point that the U.S. has been in a recession or a recession-like environment, because I do believe that, like, the CPI numbers are underestimating inflation, and I think especially if you look back, a couple of years ago, where we even had a couple of negative GDP prints. If you say that CPI is underestimated by 1 or 2%, instead of barely negative GDPs, those would have been -2, 2.5% GDP reads, and so I think to say that we're in a recession is partially true, and I think that's, again, ironically, a reason to be bullish, because it's the impotence, it's the driving force for governments to do whatever it takes. Because I think one way to really help out the U.S. economy is to get housing moving, and housing is a big chunk. When you do the direct and indirect effects of housing, it's anywhere between 15-20% of GDP by some estimates. And so this is a huge sector that has definitely been in a recession in the last few years. Construction, drives a lot of activity, sales, realtors, financial services with mortgages. So there's just a whole lot of activity that I think this administration wants to stoke in order to get that housing engine going, because their ultimate game plan is to just create this roaring economy with housing going strong, capex by corporations, government spending with the one big beautiful bill, tax cuts. And I think what a lot of people do, they're kind of fighting against this tide. They're kind of saying it's not going to work, that there's going to be, a price to pay for this, and it's going to all kind of collapse on itself. And I think, like I said, maybe there is a bubble gets blown up, and it eventually does. But I think that in the short to medium term, there's going to be incremental success on all of these fronts. And when you combine all of that, then you're going to get this drive into risk assets. And I mean, I don't want to sound like a broken record, but I think that there's a lot of good people that get into a lot of the nitty gritty on data, and they'll look at things like PMIs, which are doing better. They'll look at things like industrial production, which is doing better. Germany, I think, recently had a really good, industrial production number, supposed to be like 0.4% growth. It was like 2.5. So there's a lot of things out there that are happening, kind of under the covers, that a lot of people, they're just kind of focused at, well, we just had $900,000 in job revisions. True. And we had a little tick up in jobless claims. But again, that's the reason to be bullish, because that's the impotence for governments to say, hey, we've got to get housing going. Hey, we need to pressure the Federal Reserve to lower interest rates. Hey, we've got to keep up with our fiscal spending. We can't go into austerity because we are in a fragile quasi-recessionary economy in a lot of areas. And so these are all reasons, and this is the disconnect between the real economy and markets. And so, you can have a situation where the Mag 7 basically has very little in new net hiring, and yet their profit margins increase 20%. And that's what, drives the earnings momentum that pushes these indices higher. And yet at the same time, there's this Wall Street, Main Street dynamic, which is very troubling. And that could be another reason why this whole thing blows up, is civil unrest. Obviously, we had the Charlie Kirk assassination last week here in the United States. We have had riots on the streets in recent years for various reasons. We have the socialist candidate, Mondami, perhaps on the verge of becoming the mayor of the financial capital of the world and America's largest city. So look, we've definitely got our issues. We're a bit of a basket case here. And I think that's what scares people. But it's like, you've got to look at those underlying kind of flow dynamics with debt and deficits and earnings and different things. And the fact that there's this civil unrest is just going to push politicians around the world to be even more aggressive with driving a booming economy to quell the masses. I mean, you had like riots in the streets in South Korea the other day, and they were protesting Chinese immigration. You have a lot of these movements on the left and the right in Europe. So you have a lot of political foment in the air. And so you have all of these things. And I think if you let all of these things kind of stop you from kind of taking that leap of risk, then you miss out. And I think what's going to possibly happen is eventually everybody's going to kind of come around to something akin to the view I've been outlining, and think there's nowhere to go but up. And at that point, everybody will be in, and that's when the Minsky moment comes, and that's when you get another 50% drawdown, which, like I said, we've had a couple of those in the last 20 years or so. So this is the game. I mean, equities are a risky game. They've always have been, and there's just all these forces at play. But I think that trying to time like an imminent collapse at this point is premature.
And how do you know when to get out? I guess that's the $1 million question.
I think a good thing will probably be like just absolute sentiment. When, you know, at the end of 2024 was when I turned bearish for the first time in a while, basically since the 22 lows. And I started buying puts and raising cash in December and January. And one of the reasons was because every single Wall Street equity strategist was coming out with price targets around 7,000 on the S&P. And I just, I felt like the consensus, the American exceptionalism, Trump's going to come in and do all these bullish things. And I'm thinking like he's going to probably threaten Federal Reserve independence. He's going to lay on tariffs. There could be political unrest because he's a divisive personality. I'm like, there's some hurdles out there. And so I think that basically, a good barometer for when to get out is when the voices are very few and far between, from kind of mainstream voices, strategists on the street. When there's just this ebullience and sense that there's nothing that can happen except for a huge rally, and like I said, we're not there yet, and I don't know when that occurs, but I wish I could have a more satisfying answer, but the thing is I think ultimately markets are much more psychological than people realize, because there's no ordained valuation. There, anybody can come up with any argument about why PEs should be this or that, and they can look at the CAPE and say this is the historical, or you could get a Tom Lee out there who says, look, the equities have taken like 5-6 huge shocks in recent years, and they've bounced back from all of them. They deserve a much higher PE. You could say, interest rates are on their way down. We need to expand. Like, you can always make these valuation arguments, but ultimately, I think there's a fundamental kind of psychological factor to the markets. And I just think that at this point, we're just not anywhere near the type of blanket bullishness that would start to get me concerned.
Okay, makes sense. So Mel, thanks so much for your time today. We sort of touched on so many different avenues and parts of the markets and the economy and macro and monetary policy and everything like that and where things are going. But my last question is, what is one message you want people to take away from our conversation?
I think one thing is it's not financial advice. These are my opinions, and while I have admittedly been on a run lately with some pretty good calls and thoughts, I could always be wrong. And a black swan, by definition, is something that comes out of nowhere. And it could be another virus. It could be a geopolitical hotspot that springs up. So after, I guess my last comment, after giving all of this bullishness and where I think things are heading, is only to say that, if you're going to be in the markets, you also have to always keep in mind that your thesis could be wrong, and don't get over your skis, levering up on margin and going crazy and doing nothing but buying, all these out of the money call options and thinking, hey, this is going to put me in retirement in the next 6 months. So I think, take the level of risk that's appropriate for you. Don't be afraid to take risk, but also be aware that things can come out of left field. And that's why you get the reward, is because there is, at the end of the day, always that risk in all of these markets.
Great message. So thanks again. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
Sure. I post on Twitter, X, at Mel Mattison 1. I think there's a number of kind of imposter type accounts, but Mel Mattison 1 on the screen there. And I have a website, melmattison.com, and I have a financial thriller novel called Quaz that deals with, some of these same themes of, gold revaluation, central banks, all AI, all of that stuff. So if people are interested, they can, check out Quaz. It's available wherever books are sold, Audible version, stuff like that as well.
Great. Put it in the description below, but thanks again for your time.
Thank you, Anthony. Appreciate it.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right. Thanks again.